Hey everybody, this is Dan back with another Mortgage Explainer. Today we're going to be reviewing a loan estimate together. I put a sample together so that you can understand what each section talks about, how to interpret it, and really make sure that, when you get one of your own, that you have some information to go off of. And a loan officer really should be reviewing this with clients anyways, but that doesn't always happen. So a lot of times you might just get the initial disclosure package and then you can see this loan estimate in here, and it can be tough to make sense of it if you're not familiar with going through them. So let's do this together. I'm going to break this down. Now, I, of course, am not using anybody's personal information with this one. It's just a sample. I'm not advertising any interest rates with these. This is just for the purposes so that we can go through this together. I can go through section by section and explain how a loan estimate works. Okay. So up at the top, you're going to see your information, the applicants, the property address for the home that you're looking to purchase. And again, I am assuming with this one that a client is purchasing a home for $350,000 as the sales price with a 10% down payment using 30-year fixed rate conventional financing. Okay, so that's the situation of the one that we're going to be reviewing here today. If you're looking at other ones like for an FHA loan, it's all going to look very similar. Some of the costs of mortgage insurance and things like that could be a little bit different. So again, this is just assuming a conventional loan. Uh, and also up at the top here, you can see that it's showing the rate is not locked. So that's another good thing that, when you get sent a loan estimate, if you're assuming that your interest rate is locked, it'll have yes checked, and it should show you when your interest rate lock expires on, and that should take you through your closing date to make sure that your rate lock is good through your closing date. All right, up at the top, it shows the loan amount. So again, assuming a purchase price of $350,000, and with this one, I'm assuming a 10% down payment, so the loan amount would be $315,000. Again, with the rate, it's not an advertisement for a rate. I'm just using 7%. Rates can change daily. You always want to make sure you get an accurate quote and are following up with what the current rates are. Right in this next section, it shows the principal and interest payment. So this is not including taxes and insurance. This is just based on your loan amount and your interest rate and your term. Okay, so $2,095.70 is the principal and interest payment based on, again, the rate, the term, and the loan amount. So a 30-year mortgage. And in the middle here, you can see there is no prepayment penalty. So that's typically going to be a good thing. Most loans don't have prepayment penalties here these days, but you always want to make sure that that is checked no. Or if you do have a prepayment penalty, you're going to want to know the details. How long is that prepayment penalty? What is the cost of an early payment? And ask those questions. This is not a balloon mortgage. A balloon mortgage is something that's amortized, say still over a 30-year period, but the loan may be due and payable in full after 5 years. So even though your payments are based on a 30-year term, the balloon says after a certain amount of years, you have to pay this loan back in full or take out a new loan, and that's what that balloon is. So it's a good thing, typically, that you're not going to have a balloon payment. Now, in the middle section here, it shows the full breakdown of the payments, including the escrow account. So we can see the principal and interest is shown here again. When you're putting less than the 10% towards that down payment, you're going to have some mortgage insurance on a conventional loan. There's different ways that you can pay for the mortgage insurance. With this one, it's going to be paid monthly by the borrower. That's typically the most common way mortgage insurance is paid. So again, with this scenario, I just did an estimated quote. I'm not advertising a mortgage insurance cost, but $79 per month is what I was using for this quote for the mortgage insurance. And then estimated escrow, so $400. Now this is the estimate that I'm using for property taxes and homeowners insurance. So I'm assuming that property taxes are $300 per month or $3,600 per year for this home. And that homeowners insurance that the client found is $100 per month or $1,200 per year. Now, when you have an escrow account, your taxes and insurance are included in your payment. I do have a separate video talking about how an escrow account works, so you can reference that video for more information on escrows. So including your principal and interest, your mortgage insurance, and your escrows, that total payment would be $2,575. Now, after the mortgage insurance would drop off, once you do have 20% equity in your home and you keep the loan for a minimum of 2 years, you're eligible to drop that mortgage insurance off of your payment. Now, the only other thing that could ever change your payment in the future, as long as you keep making your payments on time, is that every year an escrow analysis is done. So they can never change your principal and interest on a fixed rate as long as you're making your payments. But they can adjust your payment in the future based on if your property taxes and your homeowner's insurance costs fluctuate on a yearly basis. If they go up, they could increase your payment slightly, or same if they go down. Okay. And here's just showing you that property taxes and homeowners insurance, yes, they are in escrow. And again, we're showing $400 a month because it's $300 for taxes and $100 for the homeowners insurance. At the bottom here, we can see the estimated closing costs, and we'll review what those mean on page 2. Those are not all loan costs or lender's fees. Some of that is for your escrows and for your homeowners insurance and things like that, which we will review. And then also I'll show you how we come up with this estimated cash to close, the $38,836 based on this situation, okay? So on page 2, here's important to review what the closing costs are. We saw what the interest rate was that was being offered on the top in this situation, but the interest rate doesn't tell the whole picture. It's also what are the closing costs that you're paying? Are you paying any points to get that rate? What are the other fees? And that's what we see on page 2. In the top section here, section A under the origination charges, in this one, I'm not showing any points being charged for this interest rate. If you pay points, typically you might be able to buy the rate down to get a lower rate. That means you have to come up with more money out of your pocket to bring to closing up front. And you should talk with your loan officer about the options, whether it makes sense to pay points or not. I typically don't recommend it, but there are situations where it may be required or it may make sense for some clients. But again, here I'm not showing any points. A lot of lenders do charge an underwriting fee and potentially also a processing fee. And a processing fee would also show up in section A here under the origination charges for the loan costs. I can show my clients options that we're not charging any underwriting fee and we can waive that. I just like to include it because there's typically some lender fees that you'll see there in section A. Now, if you're working with a broker as well, sometimes it's a borrower paid broker fee where you could see a broker fee being charged here. But then a lot of times you may see a lender credit down at the bottom, crediting back some or all of that broker fee. So that's something to keep an eye on for you as well. Now, in section B, these are services you cannot shop for. So typically you're going to have an appraisal done when you're purchasing a home. The cost of the appraisal is going to be dependent on what type of home it is, the location, the size of the home, and different things like that. We cannot choose our own appraisers, but we do have to order the appraisal as a lender, and it's assigned to an appraisal management company that will find a local appraiser that'll go out to do your home. So clients cannot choose their own appraiser, and so that again is a service that we cannot shop for because it has to be a complete third party to everybody in the transaction. Also, you may see a lot of times a credit report fee here, sometimes a flood cert fee charged to make sure if the property is or is not in a flood zone. Our credit report fee charge kind of is a catch-all. It includes a couple of the other services like the flood certification. Now in section C, these are services, again, that you can shop for. So lender's title policy, so the lender's title insurance. In Wisconsin, it's very straightforward. $450 is the current charge that title companies will charge for the title insurance, which is required whenever you are taking out a mortgage on a home. And then the title company also does the closing for lenders and buyers and sellers as well. And so company that we use currently charges $300 as a closing fee. So again, when you're looking at a home, you do have the right to shop around for what title company that you would like to use. Again, in Wisconsin, there's not always too much of a variance between title companies. A lot of them, might have $50 plus or minus for their closing fee. But it is always good to get more information and ask those questions so you can know what your options are. So at the bottom, section D just adds up these sections that we just talked about together. So the loan charges, which again are typically lender's fees, Section B, which is third-party services that you cannot shop for, like appraisal fee, credit report. Also, I should mention if you're purchasing a condo, there may be a condo questionnaire fee that your condo association may charge to complete the condo questionnaire. That would typically be included in this section as well, and that might be around $250 for most uh, condo associations. And then again, the title fees, which you are allowed to shop for. So that totals up to the $2,470 here in Section D. Now we go back up to the top and we look at some of the prepaids. So again, in Wisconsin, the county does charge $30 to record both the mortgage and the deed. And so it's a total of $60 in recording fees to record the mortgage and the deed at the county courthouse, because those are public records here in Wisconsin. Section F are the prepaids. With purchasing a home, you have to have homeowners insurance. You set it up yourself, choose your own company that you'd like to work with. And again, I'm estimating $1,200 per month in this example. And that's the annual cost. And you always have to pay homeowners insurance a year in advance. So that's why it's showing it. If you have not paid the insurance company before closing, you can have it paid at closing. So this is showing we'd collect $1,200 at closing, and the title company would send those funds to your insurance company so that you're paid for a full year in advance for your homeowner's insurance. Now, prepaid interest, this is interest from the date of closing or the date of funding until the rest of the month. So in this situation, assuming that somebody's closing in the middle of the month, they're purchasing a home. So right now it's the middle of August. And if somebody closed here today, their first mortgage payment would not be due until October 1st. Okay, so there's not a mortgage payment that somebody would make in September. And that's because whenever you make a mortgage payment, that pays the previous month's interest. So when you're making your October mortgage payment, that pays the mortgage interest for September. And that's why you're not making a September mortgage payment, is because you haven't owned the home for the whole month of August. And so since that's the case, again, we're collecting the interest from the date that your loan funds, which is typically the closing date on a purchase, for the remainder of the month here in August. So that's that prepaid interest. Now, again, I had that other video on the escrows, but I just wanted to point this out here too, because typically when you put less than 20% towards that down payment, you are required to have an escrow account with a conventional mortgage, where we do then establish that account with 3 additional months of homeowners insurance and 3 months worth of property taxes. The reason is that, A, you don't have a payment due that first month after closing, so we collect 1 month of taxes and insurance to put in the escrow account, which again, the escrow account, just briefly here, works just like a savings account where money is put here as we establish the initial escrow account or savings account. That money is put in there, and as you make your payments, as you saw up on the top, you're also paying additional per month in your mortgage payment for taxes and insurance, which is also going into your escrow account every time you make a payment, with the idea being that at the end of the year, or when your property taxes come due, you have enough money in the escrow account to pay your taxes in full. And then same with your homeowner's insurance. So 12 months from when you purchased your home, because remember, you're paying a full year of insurance ahead of time for the first year. But then a year from now, you're going to have another payment due for your homeowner's insurance to pay another year in advance. And that's why we're establishing and collecting 3 more additional months of homeowner's insurance to make sure that we have enough money at the end of enough money next year to pay that in full. And then again, it's 3 months because there's also a 2-month cushion that lenders can collect in the escrow account. And that's to account for the possibility that your taxes or insurance may increase on an annual basis, right? We don't know what those bills are going to be next year until we actually see the bills. So there is a 2-month cushion of taxes and insurance in your escrow account, so that once that bill comes out, there's some extra money in there. And that's always your money, by the way. If you ever sell the house, refinance, or close the escrow account in the future, whatever the remaining balance is in the escrow account, that's still your money that you will get back. Okay, but that's why we're showing collecting and establishing the escrow account here up front with the 3 months, One, because you're not making a mortgage payment right away that first month, and then also that 2-month cushion that I just talked about. So then we add up this section here, and that's $3,366 when you add up sections E, F, and G. And then in section J, so this totals what we just went through on A, B, and C, and E, F, and G, right? So those are the total costs, $5,836. And you can see that matches what you see up at closing costs on the bottom of page 1 when we were just reviewing that. So on the bottom of page 1, that is not just all lenders' fees that you're paying for the loan. You can see as we just broke it down here on page 2 that this includes all the charges. It's the loan costs, the title fees, the appraisal, your prepaid items, your insurance, your escrow account. So that includes everything. Now you'll notice too, what I did not include in here is the cost of a home inspection. And that's because you are not required to get a home inspection in order to purchase a home. That is up to you when you're writing an offer, whether you are going to include a home inspection contingency or not. And even if you do have a home inspection done, which of course we always recommend, that is paid separately. You get to choose your own inspector. You get them out to the house early on in the process, and you pay them outside of the rest of what we do here on the mortgage side. And we do not even want a copy of your home inspection, but again, it's always recommended, and you don't see the cost in here because you take care of that separate from the rest of these items. Okay. So then we're calculating cash to close down at the bottom here. You can see we just went through what the closing costs all add up to, the $5,836. The down payment was that $35,000 because, again, based on our purchase price, $35,000 is 10% of $350,000 as the purchase price. And I just wanted to include this in here too. So a deposit, so minus $2,000. So again, in this example, I assumed that the client was putting down a $2,000 earnest money deposit to the sellers. Typically, it's a good faith deposit you give to the sellers up front, and then at closing, they give you a credit back. So basically, that upfront deposit in earnest money is just you giving them money that's later put towards your down payment. You're not losing that earnest money. You get that as a credit back at closing. So then in total, when you add up your down payment and your closing costs, but then you subtract your earnest money that you gave them, so the remaining cash to close that this client would have to come to closing with is that $38,836. Okay, so those are the meat and potatoes here of the loan estimate. And I just wanted to make sure I went through that with everybody. Page 3, it's always interesting. These numbers can sometimes be scary for clients. It shows, in 5 years what you've paid in principal and interest and mortgage insurance and loan costs over the first 5 years. Certainly, you're paying more in interest at the beginning of the loan when your loan balance is higher. That starts to invert the further in that you get to paying your loan and the lower that your loan balance gets. APR is also a topic for another video. Quickly, the APR is not your interest rate, but it does factor in the fact that you are also paying, mortgage insurance in this situation, and that there are some upfront closing costs that you have to pay to get the loan. So the APR takes into account your interest rate, but also those other factors like closing costs and mortgage insurance to say this is your annual percentage rate. And then at the bottom here, it shows that, again, we may need to have an appraisal done. With the assumption of mortgages, most loans are not assumable these days, not a conventional mortgage, which means that when you go to sell your home, somebody else would have to take out a new loan. They cannot assume the remainder of your loan. They have to get their own financing. Late payment. So with a conventional mortgage, your mortgage payment is due on the 1st. You have a 15-day grace period each month to make that payment. If you do pay after the 15th, your lender will typically charge a 5% penalty based on your principal and interest amount, but they will not mark you late to the credit bureaus unless you are more than 30 days late. Refinancing, again, there's no prepayment penalty with this loan, so a client can refinance anytime. So if the rates come down or anything like that, there's no penalty to refinance. And then typically with servicing, what will be checked is that most lenders want to have the option to transfer servicing of the loan if possible. So after closing, you'll get a copy of all your closing documents. You'll get some payment coupons and things like that. And then the loan is typically sold to Fannie Mae or Freddie Mac even before you start making your payments. And then by the time your first payment is due, typically you will be set up with servicing so that you can make your payments online, set up automatic payments if you want, or do them manually, whatever you like. But it's always possible that your loan servicing could get transferred. So even, years after you have closed on your home, who you're making payments to could potentially change, although they cannot change any of the terms of your loan. They can't raise your rate, charge you any extra money because your loan was transferred. They have to give you notice from your original company and from the new company. So most of the times, people will see that lenders hold the right to transfer servicing if they'd like to. So I know that's a lot of information to go through, and this is just one specific example, but hopefully going through this has enlightened you to say, okay, I understand what each section now could mean. And again, depending on different properties and different companies, you could see some different charges in there too, but just be aware of where the charges are and what section they are. Again, when you're seeing an interest rate advertised, it's always good to see, okay, well, how much are my loan costs? And how much are the lender's fees in order to get this rate? Am I getting any lender credits at all, at a certain rate? So these are all important things to know when you're talking about loan estimates and trying to figure out, what it all means. So I really do appreciate you guys sitting through this. Hopefully this was helpful for you. I'm happy to put, actual proposals together for clients and review loan estimates. So contact me here anytime. I'm always happy to help. Thanks again. Hope you all have a great day.